You have been diligently investing 25,000 rupees every month through SIPs. Fast forward 10 years. Your portfolio now shows 56 lakh rupees. Sounds like a win, right? But what if I told you that 56 lakh isn't actually worth 56 lakh? There's a silent force working against your wealth: inflation. It quietly erodes the real value of your money even while your investments grow. Hello and welcome to our channel 5 Minute Finance by ET Money, where we discuss the basics of investing and personal finance. In this video, let's uncover how inflation can shrink your wealth without you even realizing it, and more importantly, how you can protect yourself. For the beginners, let's quickly brush up the basics. Let's understand what SIP is, how it grows your money, and what inflation is. SIP or systematic investment plan is a simple way to invest small amounts of money regularly in mutual funds. It's like a monthly savings habit that helps your money grow over time. SIPs make it easy to start investing even with just a few hundred rupees. So it is one of the simplest ways to build wealth thanks to its two key benefits. Compounding. Your returns start earning returns. Rupee cost averaging. You buy more units when markets fall and fewer when they rise. But while SIPs help you grow money steadily, there's a hidden enemy working quietly in the background: inflation. Let's take a quick look at how inflation affects you. So inflation is the rise in prices of goods and services over time. Think about it. That liter of milk which cost rupees 35 a few years ago, it's now worth 60 rupees. School fees, medical bills, rent, everything is more expensive than it used to be. This rise in prices reduces the purchasing power of your money. In India, general inflation usually stays around 5 to 6% a year. So if your money is not growing faster than that, it's actually losing value. But how do we measure inflation in India? We track it using two key indices: Wholesale Price Index and Consumer Price Index. WPI, Wholesale Price Index. As the name specifies, WPI tracks wholesale prices but does not include retail or services. CPI, Consumer Price Index, measures how prices change for things you and I buy daily, from food to clothing to education, directly indicating retail inflation and affecting consumer budgets. Now, for an individual, the Consumer Price Index is more relevant. CPI measures the change in prices of everyday goods and services like food, transport, housing, healthcare, directly affecting your cost of living and purchasing power. It reflects the inflation that individuals actually experience. On the other hand, WPI is more useful for businesses and policymakers to track wholesale price trends, not individual expenses. On your screen is the historical CPI inflation trend in India since 1960. While there were years of high inflation, CPI has mostly stayed within the 10% range. On average, India's annual CPI inflation since 1960 has stayed about 6 to 7%. But well, before we proceed, listen to this carefully. When we hear that average inflation is around 6 to 7%, it feels like a simple number. But that number does not always tell the full story. Because inflation isn't the same for everything you spend on. It's not like a flat rate on everything you purchase. For example, education inflation in India is currently rising at around 10 to 12% per year. That's almost double the average rate. And healthcare costs, they have been going up by about 14 to 15% annually. So the inflation for different areas, for different expenses, can vary significantly, like we saw in case of child's education or medical expenses. Prices are increasing much faster. This is why it is so important to plan your finances by considering specific inflation rates, not just the average. While your SIP may look good on paper, the actual value of that money might tell a very different story. Here's a simple formula you need to remember. Real return is equal to nominal return minus inflation. On paper, your mutual fund might show a 12% annual return. But if inflation runs at 6%, your real return is just around 6%. That's because inflation silently eats into your gains, reducing what your money can actually purchase. Let's continue with the previous example. You invest 25,000 rupees every month for 10 years. That's a total investment of 30 lakh rupees. At 12% returns, your portfolio grows to 56 lakh. But after adjusting for 6% inflation, the real value of that 56 lakh is only around 31.27 lakh. So yes, you made money, but not nearly as much as it appears on paper. Now look at your screens. Let's stretch the calculations over a longer time horizon and see how inflation affects your purchasing power. Did you notice the pattern here? While your SIP value grows at a faster pace year after year, the real purchasing power of that money grows at a much slower pace. After 30 years, your statement may show 7.7 crores, but considering inflation, that's worth only 1.34 crore in today's terms. Here's where many people go wrong. They plan for the future using just nominal returns, and that's a problem. Let's take a common goal, your child's higher education. If it costs 50 lakh today, what will it cost in 15 years? Let's assume 6% annual inflation on conservative note. So to accomplish that goal which costs 50 lakh today, you will need to accumulate 1.2 crore to accomplish it 15 years later. Now imagine you have been saving every month thinking 50 lakh will be enough. But when the time comes, actually you are only halfway there. This is how inflation quietly sabotages your plans without you even realizing it. It's not just about growing your money, it's about growing it fast enough to outpace inflation. And well, you can do that via SIPs itself if you use them right. SIPs are a great way to build wealth, but only when you plan them with inflation in mind. So to stay ahead, you can do these 4 things. Number 1, choose equity mutual funds for long-term goals. Over 10-15 years, they have historically delivered inflation-beating returns. Number 2, stay consistent. Don't stop your SIPs during market dips. That's when you accumulate more units at lower prices. Number 3, review your goals every year. As inflation keeps rising, your SIP amounts may need a top-up. Number 4, use goal-based investing. For a goal 15 years away, assume 6% inflation and calculate how much you really need to invest today. So SIPs don't just help you invest, they can help you stay ahead of inflation as well. And with this, we have come to the end of this video. So before you feel too good about your growing SIP corpus, find out what your real return after inflation is. Because at the end of the day, it's not about how big your number looks on paper. It's about what that number can actually buy.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.